Hello and welcome back to another lecture video dealing with Chapter 8, Notes Receivable, Accounts Receivable. In this video, we're going to look at Notes Receivable or promissory notes. So by the time you complete this video, you should be able to not only calculate, but explain the calculation of interest on notes receivable, and you should be able to prepare the journal entries to record not only notes receivable, but also interest as well. Okay. So what exactly is a notes receivable or a promissory note? Promissory notes are receivables, and they're a lot of the times used in sales transactions, right? We use these when we have credit terms that are going to be longer than 30 days, okay? Usually we're looking 60 days out, okay? This is a common thing that happens in business. We're going to sell somebody merchandise on account, not a problem. Anything longer than 60 days, we're going to want a promissory note, okay? So what are the key characteristics of these promissory notes? Well, number one, they're going to include some interest, right? An interest rate is going to be stated, and that interest rate is always going to be stated on an annual basis, okay? Usually within the promissory notes, there's going to be a fixed due date, meaning within 120 days, you're going to pay me for this merchandise that I sold to you, okay? So it's going to have a fixed due date, or we might see on demand, okay? And then there's always going to be some certain principal amount that needs to be paid on this note. So how do we calculate interest, okay? Well, it's very simple. We take the principal times the interest rate times the interest time, okay? Now, keep in mind that interest rates are stated on an annual basis, right? These notes payable are going to be longer than 30 to 60 days. So that means we're going to have to break down our interest rate for the time period, okay? What do we mean by that? Well, let's look at an example, right? Let's say we have a 3-month, $10,000 note, okay? It has an interest rate of 6%. That 6% is the annual interest rate, okay? We're lending somebody, I don't want to say lending, that's bad. We're selling merchandise worth $10,000, and that person said they're going to pay us back in 3 months. Okay, not a problem. We want you to sign a note, and we're going to charge you some interest on this, okay? So what we need to do is we take our principal amount, which is $10,000, times 6% times the time, right? Well, what's the interest time? Well, it's 3 months out of 12, right? So we're going to multiply that by 3/12. We end up with an interest amount being $150, okay? So let's see an example of how do we record this. Super simple, right? So we sold somebody merchandise on account for 10 grand. They said they can pay us in 3 months, or they need 3 months to pay us. We say no problem. Sign a promissory note. We're going to charge you interest. They're fine with it. We already calculated the interest, right? So we need to calculate, or we need to record that interest of $150, right? We are the maker of the note, meaning we issued the note. So we are going to first debit interest receivable and credit interest income. This is an adjusting entry that we use to accrue income, right? Remember, it was chapter 3 or 4, we did accrued revenues. This is a prime example of an accrued revenue, okay? Again, credit interest receivable, it's a receivable. Debit, debit interest receivable, credit our interest income. So what happens when the interest is actually paid to us? Well, that's simple. We know how to do this, right? In order to record receipt of an interest payment, we debit cash. Why? Because we're getting cash. We debit cash. We credit interest receivable to show that that receivable has been satisfied. Okay? So now we got to look at accounts turnover, right? Or accounts receivable turnover, average collection period. Why do we use these, right? What are they important for? Well, these are the accounts receivable turnover and the average collection period are very, very similar to what we learned last week looking at inventory turnover, and day sales in inventory, okay? These kind of go along the same lines, right? So we want to analyze our receivable, right? What's important to us as managers is based on the speed of which we collect our receivables. So we're going to use two ratios to kind of calculate out that speed, right? We're going to use the accounts receivable turnover, and we're going to use the average collection period. How do we calculate these? Super simple. The accounts receivable turnover is net sales divided by average accounts receivable. The average collection period is 365 days divided by the accounts receivable turnover. Now, I'm hoping that as you're looking at these, you're having like deja vu, because you should. Because accounts receivable turnover is identical to inventory turnover. The only difference is one we're using average inventory, the other one we're using average accounts receivable. Average collection period. That should look kind of similar, right? Because think back when we looked at inventory. 365 divided by some number, right? The inventory turnover gave us that day sales in inventory, right? Same exact thing. The only difference is we're looking at receivables. So we want to figure out the average collection period, 365 divided by the accounts receivable turnover. Okay? Super simple. We need to talk about factoring and discounting. Okay? This is pretty important, right? A lot of times, companies don't want to collect on their receivables, right? Meaning they have an asset, that accounts receivable or that notes receivable. They can sell those, okay? They can sell those to another company. And that company is basically going to hold those receivables and they're going to collect those payments, okay? So we call this factoring the receivables, right? And basically, the company receives cash less any discounts from the buyer. What does that mean? Well, let's say you guys in the class own a company, right? And you do a lot of sales and they're on receivables, right? You have a lot of receivables. And you're like, man, I need the cash for this. I don't want to wait for this money to receive. Or I don't want to wait for these customers to pay me, right? So you call Professor Bruce up and you're like, hey, you want to buy my receivables off me? He says, you're factoring. Sure, I'd love to. I say, okay, I will take your receivables and I'll collect on those, okay? However, your receivables are $500,000. I'm not giving you $500,000 for those. Maybe I'll give you $480,000. And you're like, hey, that's fine. That's good enough for me. So what happened was you discounted your receivables, right? You're getting cash less that discount fee, okay? Now, there's two types of ways that we can sell receivables, okay? We can sell them without recourse or with recourse. What's the difference? Well, let's look at without recourse, right? If the receivables are sold without recourse, meaning you sell them to me, I buy them off you, okay? Me, as the buyer, cannot request reimbursement for the amount that is not collected, okay? So that means that you sell me $500,000 worth of receivables. I give you $480,000. And let's say that 50,000 of those are uncollectible, right? I can't collect them. You offered credit to deadbeats. They're not paying, okay? Since I own the receivables, I'm entitled to those payments. And because it's without recourse, that means that I can't come to you guys and say, hey, you still owe me 50 grand. Your customers, $50,000 worth of your customers did not pay their receivables. You owe me that money. You say, well, hey, we sold without recourse, so nope, tough. Okay. Well, I'm smart. At least I think I am. So you approach me and you say, hey, I want to sell $500,000 worth of receivables. This time I say, sure, I'll buy them off you, but I want them sold with recourse, which means me as the buyer, I have the right to return to you any uncollected receivables. Okay? So let's use the same example. I give you $480, you give me $500,000 worth of receivables. I collect. $50,000 of those are deemed uncollectible. Guess what? I return them to you. That's it. That's the difference. Don't worry about the direct write-off method. We're just gonna stick, because due to time constraints and whatnot, we're gonna stick with the allowance method. The direct write-off method for bad debt and all those, we don't have to estimate, and it violates the matching principle of GAAP. So GAAP doesn't allow us to really use the direct write-off method, okay, unless there's an immaterial amount of bad debt expense. We're not going to get into that. Don't even worry about it for now, okay? All right, when we come back, I'm going to run through some demos. You have homework. Off the top of my head, I believe it's, I'm not even going to say. You have some homework problems. I'm going to do the B problems of those in a demo video to help you out with your homework, okay? So tune back in for those. Thanks, and have a great day.